Mike, I want to go 60,000 feet on you. We have had a stretch of disinflation from Volcker to Mike Wilson right now. Do you sense that this is a nuance within a bull market wrapped around fixed income, commodities, the rest of it, the dollar, et cetera? Or are we at a point of a major change in the vectors to 2025?
Well, look, I mean, we've had that view for a while. We felt like last year's pandemic was the catalyst to kind of move us out of this disinflationary, deflationary world we've been in for 20 years, quite frankly. A lot of other things, were happening before the pandemic, deglobalization, some of the populist movement, which was talking about, inequality of wealth and income, and that train had already left the station. So the pandemic, which, by the way, pandemics are typically inflationary. So that was a perfect foil to get the transition from monetary policy dominance to fiscal policy dominance, and it's begun. And normally it happens with what I call a kickoff move, Tom. When you see big trends change, you get a big kickoff move, and that's what we've seen in all the inflation indicators. My best guess is it'll settle down, but then the trend is changing. And so it's going to be a long journey ahead. It took us 35 years to get here. It's going to take us 35 years probably get to the peak in rates. It's going to be a slow moving train. And, essentially what I'm saying is buy the dips on inflation.
Mike, the equity market, you're looking for a 10% move lower on the S&P 500. We've had 5 percentage points of it. Are you seeing with increasing confidence it could be worse than that? It could drift towards that other level you were looking for, a 20% move. If you are, why?
Yeah, John, I mean, last time we chatted about this was kind of after we made that lean. It was prior to the situation in China with the property development company. And, look, I think what happened here is, we've got more data on the idea that not only are we getting a tightening of financial conditions from the Fed, lower multiples, but we're also getting a greater slowdown than perhaps is expected now. We're seeing it in the earnings numbers. You guys have been talking about the cost pressures, the supply issues and constraints, but there's also this payback in demand thesis that we've had for quite a while. Our cost thesis is playing out now. People are aware of it, but I don't think they really appreciate how much payback and demand there's going to be in these areas that we overconsumed. Okay, so the bottom line for us is that risk has increased, and it's not our base case yet, but clearly moving that way.
Mike, touch on this. You've touched on it briefly. Build on it for us. What we've seen over the last several months has been so well flagged. It's talked about so much, so well known, and yet clearly from your perspective, poorly priced. Mike, why is that?
Well, it's not poorly priced at the stock and sector level, right? I mean, we've talked about this too, John. I mean, it's been basically a rolling correction since March. That's when we made the mid-cycle transition call. The market has moved aggressively towards high quality, large cap, high quality in particular. And what the market is saying is that we're taking shelter. The market, it's got to own something, right? And what happens is people move to, the highest parts of the land away from the flood. And that's what the high quality stocks are. Typically, when you get to the point, the moment of truth, which is now, which is where the earnings start to get cut and where the Fed actually, moved to tighten, then even the high shelter areas are no longer protected. And that's how the mid-cycle transition ends. So, I mean, the script is really playing out to a T. It's hard to trade. There's a lot of cross currents, but generally speaking, we're right on schedule, and it should finish up in the fourth quarter.
As you said, the rolling correction since March has left a lot of big stocks, like big tech stocks, down substantially. If we get a full 20% correction here, what will be the drivers of that, given how significant the correction's already been in some of the major components of the indexes?
Well, Lisa, but I mean, quite frankly, those stocks benefited tremendously from March until recently. So they had a huge move up, and that's what's held the averages up. So now they're going to have their, comeuppance, and they may not even go back to where they were in March, and that would be a big drop. But they're going to have to go down if the major indices are going to have this 10 to 20% correction, and that should happen anyways, because, quite frankly, those stocks are most vulnerable to a tightening of financial conditions. And not all of them, but I think several of those companies are also vulnerable to this payback in demand from the overconsumption during the work from home period.
So what's the driver then? Is it going to be just a direct yield correlation story that basically as yields go up, the big tech stocks sell off, or is there going to be an earnings component as well?
Yeah, I think it's both. I mean, that's the fire and ice, scenario, right? The fire is basically you get a tightening of financial conditions, multiples come down. and then you get a little bit of ice on the back end of that. The deceleration that you always get at this stage of the economic cycle is normal. Now, normally what happens is, earnings continue to go up, but because the amplitude of this, recession recovery were so dramatic, you have to assume that the mid-cycle transition deceleration will be more or larger than average. Okay, I mean, to think otherwise would just be intellectually dishonest.
Mike, are we finally at a point where we've been so wrong about single-digit actuarial assumption, 10-year SPX, 15.7% per year? Can you tell your team at Morgan Stanley the single-digit equity return world is finally upon us?
Yeah, I mean, look, I mean, it's interesting, Tom. I think you understand this, but it's easier to predict stock returns over a 7-year period than it is over a 1-year period. Why is that? Because over 7 years, the value, your starting valuation comes to fruition. Okay, you can't avoid that. Your returns, your actual returns over a 7-year period are contingent upon the price you pay. And we all know assets are expensive right now, whether you're talking about bonds, which are being financially repressed, or stocks, or any asset that's tied to a 10-year treasury yield, which is artificially low. So yeah, I mean, the starting point is poor on a 7-year basis. And so it's high conviction, and this is not a big call, by the way, high conviction. It's a single-digit return outlook, okay? Not the end of the world, but I mean, that's what financial repression is. I mean, that's the world we're in, lower returns. It's not the end of the world, but that's a fact.